Hi, I'm Lance Roberts, and it is technically speaking Tuesday. And of course, I want to talk a little bit about the markets, what's happening today, as well as what we kind of expect to occur over the next few weeks or so as we head into the end of the year. But also want to go over some kind of important signs that we're seeing from the globe as we know it. And today's technically speaking post is titled "As the World Diverges." But first, the markets are up today. You know, after trade concerns yesterday, Donald Trump came out and announced another $200 billion in tariffs and threats of $200 billion more if China retaliates. Well, the markets sold off yesterday. But again, as we've seen as of late, markets are becoming very used to these announcements by the administration, and we're quickly pricing these things in. And markets continue to push higher on the expectation that economic growth and earnings will continue to be strong through the end of the year. And I certainly don't disagree with that. As we talked about here in our just recent article that we put out, this rally up to the previous highs, we broke out of this January high earlier this month and rallied to basically a little bit more than 2,900. Now, we laid out our target for 3,000, and that target is based upon this current trend of the market higher. We've been in a very defined trend channel really ever since April. We had reduced exposure back in early February when the market began to break down. And in early April and May, as the markets began to recover and start this stair-step process, we began adding in exposure on each one of these steps higher. The latest additions were made when we made this pullback to support. We made some additions to our equity portfolio last week. And of course, this trend continues to be positive. Moving averages are moving up. Everything is trending in a positive manner right now. And that certainly sets up the precedent for both our equity portfolios going into the end of the year on an expectation that this current end of the year bias will remain intact. And of course, with fund managers and hedge funds really underperforming and lagging this year, there's going to be this impetus to play catch up over the course of the last 3 months of the year as we move into Christmas, to have that reporting period on their balance sheets by the end of this year. So there's going to be potentially an upward push. And again, we had identified 3,000 really kind of as our near-term target over the next couple of months. If we get there, we'll see where we go to next. But that's going to provide, if we do get to 3,000, that's going to give the markets about a 10% return for the year overall. That's well in line with an average year of returns. And with earnings, still expanding at this point, or still at least strong from an apparent standpoint, there's certainly support here for the markets to move higher. Now, having said that, let me give you the caveat. We're not taking our eye off the ball here and just saying just because markets are rising that everything's great and honky-dory and you shouldn't pay attention to anything, just throw all your money in the markets. We're not saying that at all. We still have to manage risk. And of course, we're watching this very important support level. If the markets are unable to hold above that, we break down. We've got really critical support right around 2,800. If we break below that, we're going to see a much bigger decline in the markets. I don't expect that to happen right now. That's probably something moving into next year. But there are some signs of concerns that we are watching very closely. And this really has to do with the world at large. As we begin to look around the world, there's a very different picture that emerges. Look, here's Germany. The market has not performed well. The DAX has not performed well. The 50-day moving average is below the 200-day moving average on the DAX. And Germany continues, and it's down about 8% for the year. This negative trend in Germany is very diametrically opposed to the positive rise in the U.S. But it's not, and of course, Germany, important because they produce a lot of luxury automobiles, Mercedes-Benz and BMWs that we buy here in the States. So their production and exports and what's going on in their economy is important to what happens in global trade. Now, but it's not just Germany. Here's China. Again, same thing, 50-day average below the 200-day moving average. That's called the technical death cross there. And of course, it's down almost 9% for the year. Of course, major exporter into the U.S. We're a big customer of China. Of course, this has a lot to do. In fact, if you'll notice something very interesting as we look at these charts, this all starts right around June. That's where this trade war rhetoric really heated up. So what you're seeing here is the impact of trade and tariffs going to work on the markets. See, here's Japan, exactly the same thing. We're seeing it down. Japan down about 4% year to date, 50-day below the 200-day moving average. Again, weakness really kind of starting here back in June. Take a look at United Kingdom. Here we are, June again, markets declining, down 5% for the year. And again, This all kind of coincides, 50-day moving average below the 200-day. Again, every one of these charts that we look at are showing us exactly the same thing. Here's an important one. This is South Korea, right? Why is South Korea important? South Korea exports are a very good leading indicator for the U.S. economy because of the relationship between the U.S. and South Korea. Again, right here in June, big decline, 50-day crosses below the 200-day. And of course, we're seeing South Korea down about 6% year to date. Again, tariffs beginning to weigh in, but you take a look at export numbers from coming out of Korea. Obviously, we're a big importer from South Korean products, showing a real negative divergence here between what's happening or really there as to what's happening in the U.S. But it's not just these selected countries. I didn't just go pick these selected countries out and just say this. This was just kind of a grab bag of the big countries. Let's take a look at something else. This is the world at large, okay? So right here, this is industrialized nations. So this is all the industrialized countries around the world. France, Spain, Germany, United Kingdom. These are the big guys. So the red line here is basically the S&P 500. Here's what I want you to pay attention to. Whenever this index has been at these very, very overbought levels and you triggered a momentum sell signal in the past, it has led to pretty severe market corrections in the S&P 500. In fact, this signal that will trigger here at the end of this month, there's no doubt at this point that this signal will trigger, but this signal, every time it's triggered, has led to either a big correction in 2011, 2012, or the dot-com peak or the 2008 recession. I'm not saying that this is going to trigger off the next major financial crisis, but this signal of momentum of what's happening in these industrialized economies have been a good indicator for strength and weakness in the U.S. as well. In other words, the market, while diverged currently from the rest of the world, is not an island in and of itself. We are dependent on this globally interconnected flat world that we live in terms of trade, the one thing that the current administration is attacking directly. That does have an impact on our economy. American farmers are begging for relief right now, and we're likely to see more impact coming in to higher prices that's going to affect consumption. Here's emerging markets. Let's take a look at this. Exactly the same set of signals. Now, this is emerging markets. This is China, Brazil, South America, all the other countries that aren't industrialized as of yet. Same exact set of signals here. Markets are grossly overbought. And of course, this momentum signal triggering here, only 4 other times before this. Every one of these led to at least a correction within the market, if not a much more severe reversion in terms of bear markets. So again, while we're looking at these things, this doesn't mean that we need to panic and go sell everything and move to cash, but it is very important to understand that the U.S. can't simply just be here all by itself and be a supporter of the entire world. The rest of the world is telling us that something is not quite right economically. While we've had a big boost to economic growth in the first 2 quarters of this year, primarily driven by a lot of fiscal stimulus that came in from 3 hurricanes and 2 major wildfires late last year, which people tend to forget about, but also tax cuts as well as a massive boost of fiscal stimulus coming in at the beginning of this year as Congress has just basically alleviated all type of spending restraints. We're about to pass another spending bill here in the next few weeks as well that'll continue this kind of spending bonanza up in Washington, watching our deficits expand over $1 trillion. We will pay that price down the road. It will erode economic growth. This recent hurricane in Florence is likely to give us a little bit of a bump moving into year end. Again, more stimulus being put in. But what these natural disasters do is basically drag forward future consumption. That void is still going to have to be felt and filled going into next year. So while these indicators certainly tell us that something to miss in the global economy, don't be surprised if this starts to show up in our economic data over the next 2 to 3 quarters here in the U.S. as well. And again, while markets, and again, we're going back to what we said earlier, while we're allocated our portfolios to equities, and we do expect this to go higher through the end of this year, 2019 is our real key risk measure and real kind of flashpoint for the markets that we're watching very closely. And if we're right and we begin to see deterioration into 2019, we will be reducing exposure and protecting capital at that time. Thanks for watching, and of course, be sure to get by our website, realinvestmentadvice.com. Get our latest podcast and more as well. We're broadcasting every day at 3 o'clock with all your updates on the markets and your money right here at realinvestmentadvice.com. See you next time.